When it comes to understanding financial statements, whether you're managing a personal budget or running a business, two terms often create confusion: gross income and net income. Let's explore these concepts in detail. Gross income is the total amount of earnings received before any deductions or taxes. For individuals, it encompasses all sources of income such as salary, bonuses, rental income, or dividends before taxes or any other deductions are applied. For businesses, gross income refers to the total revenue from all sales and services before costs such as expenses and taxes. Imagine Maria, who works as a software developer. Her annual salary is $90,000. This figure represents her gross income. Additionally, if she earns an extra $10,000 from freelance work, her total gross income would be $100,000 for that year. However, Maria's gross income isn't the amount she actually takes home. This brings us to net income, which is the amount one actually receives after all deductions such as taxes, retirement contributions, health insurance, and any other expenses have been subtracted from the gross income. For individuals, net income is often referred to as take-home pay. Going back to our example with Maria, she might have to pay a total of $20,000 in taxes and other deductions. Therefore, her net income or take-home pay would reduce to $80,000. For businesses, net income represents profits after all expenses. Overheads, taxes, and costs of goods sold are deducted from the total revenue. It provides a clearer picture of the actual profitability of the business. Dean owns a small bakery. Last year, his bakery generated $150,000 in revenue, which served as his gross income. After accounting for all his expenses, including rent, supplies, employee wages, and taxes totaling $130,000, his net income was $20,000. Understanding these terms is crucial for financial planning. Gross income provides a broader view of potential earning power, while net income gives a realistic perspective on the actual financial health, be it an individual or a business. Budgeting wisely involves knowing the difference between these two and planning accordingly to manage expenses and meet financial goals effectively. The distinction between gross and net income is fundamental in various financial decisions, such as applying for loans, calculating taxes, or developing strategic business plans. Clear comprehension of these numbers aids in better financial forecasting and management, helping ensure that individuals and businesses remain solvent and profitable.